Hey there, savvy savers. Welcome back to the channel. Today, we're diving deep into a topic that could save you a significant amount of money in taxes on your hard-earned savings. In this ever-changing financial climate, staying informed about tax implications is more crucial than ever, especially if you have over £10,000 stashed away. Did you know that the interest you earn on your savings might not be as tax-free as you think? That's right. Many people assume that just because their money is sitting in a savings account, it's growing without any tax implications. But hold on. Depending on your total earnings and personal savings allowance, you could be facing unexpected tax bills. So what's the scoop? Today, we're breaking down everything you need to know about maximizing your returns while staying compliant with HMRC. Let's get into it. First up, let's talk about the Personal Savings Allowance, or PSA, introduced by the UK government in 2016. This nifty allowance lets savers earn a certain amount of interest tax-free each year. For basic rate taxpayers, that's a whopping £1,000. But if you're a higher rate taxpayer, your allowance drops to £500. And for those earning over £50,000 a year, sorry, no PSA for you. You'll be taxed on all your savings interest. Now, you might be wondering how this affects you. With interest rates on the rise, more and more savers are finding themselves in a tax pickle. For example, if you have £10,000 in savings at a 5% interest rate, that's £500 a year. For higher rate taxpayers, that means you've already hit your PSA limit. And if your savings exceed £20,000, basic rate taxpayers will also find themselves in the same boat. So how does HMRC collect tax on your savings interest? Unlike the old days, when banks automatically deducted tax before paying interest, now interest is paid gross, meaning no tax is taken out before it hits your account. This puts the onus on you to report and pay any tax due if your interest exceeds your PSA. If your interest earnings are under £15,000, HMRC usually collects the tax automatically by adjusting your tax code. But if you exceed that threshold, you'll need to complete a self-assessment tax return. Yikes! That's why it's crucial to keep track of your interest earnings throughout the year to avoid any nasty surprises come tax time. Now, here's where it gets interesting. HMRC has projected that they will collect a staggering £10.4 billion in tax from savings interest in the 2024 tax year. That's a massive jump from just £1.4 billion in 2022. This highlights how many people are now exceeding their PSA limits due to rising interest rates. If you receive a letter from HMRC saying you owe tax on your savings, don't panic. Instead, review your accounts, calculate your interest, and report the correct amount to avoid penalties. But wait, there's good news. There are legal and efficient ways to minimize your tax liability on savings interest. One of the best strategies: tax-free savings accounts like ISAs. You can save up to £20,000 per tax year without paying any tax on the interest earned. That's right, no matter how much interest your ISA generates, it's always tax-free. An individual savings account, ISA, is a fantastic way to grow your savings without the taxman taking a cut. There are several types of ISAs, including cash ISAs. These are similar to regular savings accounts, but with the added benefit of tax-free interest. Stocks and shares ISAs. These allow you to invest in stocks, shares, and funds, with any capital gains or dividends earned being tax-free. Innovative finance ISAs. These are for peer-to-peer lending and crowdfunding investments, also tax-free. Lifetime ISAs, designed for those saving for their first home or retirement. These accounts offer a government bonus on contributions. Another option to consider is premium bonds. While they don't pay interest, they offer tax-free prize winnings. Higher rate taxpayers might find this a more attractive alternative since any winnings are completely tax-free. With premium bonds, you invest your money, and instead of earning interest, you enter a monthly prize draw. The more bonds you hold, the higher your chances of winning. While there's no guaranteed return, the thrill of potentially winning big can be enticing. And here's a pro tip: consider distributing savings between spouses or partners. If one partner is a lower rate taxpayer, transferring some savings into their name could help maximize the PSA available to your household. For example, if one partner is a basic rate taxpayer with an unused PSA, shifting savings to their account could mean more interest is earned tax-free. This strategy can be particularly effective in households where one partner earns significantly more than the other. Don't forget to explore high-interest current accounts that may provide better returns than traditional savings accounts while offering some tax advantages. Some banks offer accounts with competitive interest rates, and while they may not be tax-free, they can still provide a better return on your savings. Researching different savings products and ensuring your money is in the most tax-efficient place is key to optimizing your savings strategy. If you have multiple savings accounts, keep an eye on how much interest each one is generating. Even small amounts can add up and push you over your PSA limit. One common mistake people make is thinking tax is only due if they receive a notice from HMRC. Nope. It's your responsibility to track your savings interest and report any taxable amounts. Failing to do so could lead to penalties or fines. If you're unsure whether you need to pay tax on your savings, HMRC's online calculator or a chat with a financial advisor can help clarify your liability. Another useful tool is a tax-efficient investment account, such as a stocks and shares ISA. While these involve some level of risk, they can offer better returns than traditional savings accounts and are not subject to the same PSA rules. Investing in dividend-producing assets within an ISA means you can benefit from tax-free growth and potentially higher long-term gains. Many people are now also considering moving their money into fixed-rate bonds or notice accounts, which often offer higher interest rates than easy-access savings accounts. However, it is essential to be aware that the interest earned on these accounts is still subject to tax unless they are within an ISA. Understanding the tax implications of different savings products can help you make informed decisions and ensure you are making the most of your money. If you do end up owing tax on your savings, there are several ways to pay. Most commonly, HMRC will adjust your tax code so the tax is deducted from your salary or pension. If this is not possible, or if you are self-employed, you may need to complete a self-assessment tax return and pay the tax directly to HMRC. Keeping accurate records of your savings interest and any tax paid is crucial in case of any future queries or audits from HMRC. Ultimately, staying informed and proactive about your savings tax obligations can save you money and prevent unexpected tax bills. By making use of tax-free savings accounts, distributing savings efficiently between partners, and ensuring you are within your PSA limits, you can legally minimize your tax liability. If you are unsure about your tax position, seeking advice from a financial professional can provide clarity and help you optimize your savings strategy. So, what are the key takeaways from today's discussion? Understand your PSA, know your personal savings allowance, and how it applies to your situation. Utilize ISAs. Take full advantage of tax-free savings accounts like ISAs to maximize your returns. Monitor your interest. Keep track of how much interest you're earning across all your accounts to avoid exceeding your PSA. Consider alternative savings options. Explore premium bonds, high-interest current accounts, and fixed-rate bonds to find the best returns. Stay compliant. Be proactive in reporting any taxable interest to avoid penalties. Remember, while saving money is always a smart move, understanding the tax rules surrounding savings interest is just as crucial. Plan ahead, use the right financial products, and ensure your savings work for you without unnecessary tax burdens. If you have any doubts, always check with HMRC or a tax professional to avoid surprises and keep your finances in check.